Okay, you guys, we're now going to drop back one exercise and look at 7-10. I thought it might be a little easier after we completed exercise 7-11. Let's read through it first. Again, it's on page 406. Johnson Company uses the allowance method to account for uncollectible accounts receivable. Bad debt expense is established as a percentage of credit sales. Well, if you're taking a percentage of credit sales, then you're estimating what the debit to bad debt expense should be. Unlike our other exercise, if you're taking a percentage of accounts receivable, then you're estimating what the ending balance in the allowance for uncollectible accounts should be. And I think that should make sense. Sales shows up on the income statement, so if you take a percentage of sales, you're estimating bad debt expense, which also shows up on the income statement. Accounts receivable, of course, is reported on the balance sheet. So if you take a percentage of accounts receivable, then you're estimating the allowance for uncollectible accounts, which is also reported on the balance sheet. So here, bad debt expense is established as a percentage of credit sales. For 2016, net credit sales totaled $4.5 million, and the estimated total bad debt percentage is 1.5%. The allowance for uncollectible accounts has a credit balance of $42,000 at the beginning of 2016 and $40,000 after adjusting entries at the end of 2016. So number one, it says, what is bad debt expense for 2016? Well, it's going to be equal to our credit sales, 4.5 million times 1.5%. Or $67,500. Okay, next on number 2, it said determine the amount of accounts receivable written off during 2016. Well, they give us all the other pieces to the puzzle, and they want to know what's the amount of the accounts receivable written off. Well, if you remember from the previous exercise, to write off accounts receivable, we debited the allowance for uncollectible accounts and credited accounts receivable. So we're going to go back to our T account that we used in the last problem, and we're going to know every piece except for the amount of the write-offs, and we can determine it because we know all the other pieces. So they tell us the allowance for uncollectible accounts had a credit balance of $42,000 at the beginning of 2016. So it's a credit balance of $42,000 at 1116. There we go. Now I mentioned to you earlier that the account could end up with a debit balance at the end of the year. Well, we debit allowance for uncollectible accounts when we write off accounts. So if we ended up writing off more accounts than our estimate was at the beginning of the year, it would have a debit balance at the end of the year before adjustment. Okay, so here we have a beginning credit balance for $42,000. Okay, we know we're going to debit bad debt expense and credit the allowance for uncollectible accounts for the $67,500. Is our credit for the adjusting journal entry. Okay, and then they say we have an ending balance after the adjusting entry of $40,000. And of course that's going to be a credit balance. So like I said, we know the beginning balance, we know the amount of the credit for the adjusting journal entry, which would be a debit to bad debt expense, and we know the ending balance on 12/31/16. What we don't know is the amount written off. Well, it's got to be the debit that leaves us with a credit balance of $40,000. So you can add these two together. Gives us a total on the credit side of $109,500. So our write-offs would have to be equal to the credit of $109,500 minus the ending credit balance of $40,000. So our write-offs must have been $69,500. Had to be, right? Yeah, that won't work. This one was just the total of those two. Our total over here at that point was 0. So let's do a hard line there so we know that's a total. Sorry, I did a little formatting for you there. Okay, so we'll total both sides. We got a credit balance of $109,500. A debit was 0 so far. We know we're going to end up with a credit balance of $40,000. So the amount of accounts written off, which would be the debit to the allowance account, had to be $69,500. Hope that makes sense. You add together your two credits, right? So you get a credit total of $109,500. But you know the ending credit balance is only $40,000. So we must have debited the account $69,500. And the only time we debit the allowance for uncollectible accounts is when we write off an account, like we did back here. I know this is a previous problem, but remember it was debited here when we wrote off an account. Don't try to make these numbers go with this problem. The only time it's debited is when we write off accounts receivable. So the amount of the write-off had to be $69,500. That's the answer to question 2. So I'm going to put that here. Amount of accounts written off in 2016 equals, what was it, 69,500. That's it. And let's copy this format. Okay. And then number 3, they ask, what if we used the direct write-off method? So number 3, let me read it. If the company uses the direct write-off method rather than the allowance method, what would be bad debt expense for 2016? Well, bad debt expense for 2016 under the direct write-off method Well, no matter which method you use, the allowance method or the direct write-off method, the amount of accounts written off during the year would be the same. So it's still going to be $69,500. Well, let's talk about the direct write-off method. We're required to use the allowance method under generally accepted accounting principles on our financial statements if the balance in accounts receivable is significant. So let's say our total assets are $100,000 and the balance in accounts receivable is $30,000. Well, that's 30% of our assets. I'd say that's significant. So we'd have to use the allowance method, set up the contra asset account, and write off our accounts like you've seen in these two exercises. But if our total assets were $100,000 and accounts receivable were only $1,000, then we wouldn't have to set up an allowance, because if the entire $1,000 in accounts receivable turned out to be no good, 1,000 out of 100,000 is not going to be enough to change someone's mind about the business. It's not material to the financial statements. So we'd use the direct write-off method. Well, under the direct write-off method, let's say an account goes bad for $10,000. We don't set up the allowance. We don't do this adjusting entry at the end of the year. Let's say an account goes bad for $10,000. We just debit bad debt expense for $10,000 and credit accounts receivable to take it off the books for $10,000. That's much easier than if we wanted to put it back on. We'd just reverse this entry. It's a much easier method. The problem is we end up with a bad debt expense on the books in year 2 when the account's uncollectible. When we made the sale on account in year 1, remember, under generally accepted accounting principles, we want to match that expense in the same period as the revenue it relates to. Where you'll run into the direct write-off method more, or not more, you'll run into it all the time, is for tax purposes. Because the tax code won't let us take any bad debt expense before we know the account is actually uncollectible. So you have to use the direct write-off method for tax purposes, and you're allowed to use it if the accounts receivable balance is insignificant in comparison to total assets on the balance sheet. But the bad debt expense under the direct write-off method would be the same as the amount of accounts written off under the allowance method. Okay, you guys, try exercise 710 on the Connect Plus. I don't think you'll have any problems with it. I hope not. Good luck.